It's just like being in the classroom again. You say, okay, let's go, and everybody keeps talking. Well, I want to thank you all for being here today for a very special opportunity for North Dakota State University to host, but for our entire community and our statewide audience to enjoy. You know, it's easy when you say the Federal Reserve Bank, everyone has some vague notion of what that is. But can you imagine the challenge of trying to compete, to balance the various competing interests in setting national financial policy? It's almost impossible when you think of importers, of exporters, of different segments of industry, of society, and the Fed has to figure out how to make everybody happy, or at least get somewhere near a common median of that. It really is an impossible job, but reflecting their interest in serving the citizens that they ultimately work for. They use a very dispersed model. There are 12 different locations of the Federal Reserve System: Boston, Chicago, New York, Kansas City, Philadelphia, Dallas, Cleveland, San Francisco, Richmond, Atlanta, St. Louis, and right by us, Minneapolis, St. Paul. We're very fortunate that we have these representatives here today to both talk with us, but I think also my sense is to listen to us as well, and my hope is that we're going to have a conversational experience. I do want to credit the Fargo, Moorhead, West Fargo Chamber of Commerce, who has been a partner in presenting this, as has been our local Rotary clubs, and if I don't mind, Heather Rank from the Department of Commerce, but also the emissary of Rotary, to come up and say a few words about their involvement.
Thank you so much. I'm here today in my capacity as president of the Fargo Rotary Club. There are 5 Rotary clubs here, and Rotary is an international service organization over 110 years old, and there are over 1 million members and 35,000 clubs around the world. So we are mainly working professionals who also have a commitment to high ethical standards in business, but making the world a better place. So when you get people like that together, really cool things happen. Right now, our biggest initiatives, we're trying to eradicate polio from the face of the earth. We do a lot of projects to build playgrounds. So that's a picture of a playground we built locally, and water wells internationally. So we're very honored today as well. We have a lot of Rotary members here. We're a lot of finance and business professionals and have a keen interest in listening, learning, and sharing perspectives, because we all have an interest in improving and keeping our economy strong. And if anyone here has an interest in joining a local Rotary Club, fmrotaryclubs.org has the 5 local clubs listed where you would be welcome to join us. Thanks.
Thank you, Heather, and again, thank you to the Chamber of Commerce for their support in hosting this day of activities. It really is a particular pleasure to introduce the President of the Federal Reserve Bank in Minneapolis, and I say particular because I had the good fortune to have a small group of business leaders have lunch with Mr. Kashkari today and get to know him a little bit, also get a sense of the sorts of policies and challenges that he faces in his daily life. So when I say it's a pleasure to welcome Neel Kashkari to NDSU, I mean that in a very sincere and personal way. Mr. Kashkari comes from a family well immersed in higher education. I'm not going to go through the family's various degrees, but Neel has 2 degrees in mechanical engineering as well as an MBA from the Wharton School. Fairly impressive academic credentials that have led to a long and illustrious career, both in the private sector but the public sector as well, at various levels of federal service to our country. Really pretty exceptional. We'd be here for the rest of the hour if I started going through the resume, but really is an honor to have someone of his distinguished character and qualifications to be here. I also want to recognize Ms. Kathy Nessett, who, aside from her role as a statewide business leader and her moonlighting job as a member of the State Board of Higher Education, is actually on the board of the Minneapolis Fed, and it's a real pleasure to have you here from across the state visiting with us today. At this point, I want to turn the program over to the Ron and Kay Olson Dean of the College of Business, Dr. Scott Beaulieu, who will be moderating our session today. Dr. Beaulieu.
So thank you all for being here. I think that Neel and I discussed at the outset that he's just going to kind of describe a little bit what the Federal Reserve of Minneapolis does, how it fits into the larger structure of the Fed, and helps inform and fuel Federal Reserve policy. One thing that is really exceptional and extra special about having you all here right now, Neel, is he's a father, a new father, 2 months into fatherhood. Congratulations on that.
Thank you.
Thank you for getting on the road today and being here. And he has a beautiful little daughter back in Minneapolis. So it's extra special that you made the trip over. So thank you. And I'll turn it over to you. I've got a few questions. I could ask him questions the entire hour too, but my plan is just a couple, and then hopefully with our mic runners, you all we'll have questions for him. We have just about every banker in Fargo in town, so if we ever wanted to set interest rates for the city of Fargo, today is the day, guys, but the Fed is here, so watch out what you do, okay? So be careful with your colluding. So please, ask some questions and help me out, otherwise we'll just get into the weeds of economic policy and theory. So Neel, thank you again.
Well, thank you, Scott, and thank you, Dean. And all of you for being here today. I really appreciate it. And in addition to acknowledging Kathy, who's a real North Dakota leader who's on our board. And by the way, Kathy was on the search committee that selected me, so thank you again, Kathy. Another next to Kathy. I think so. I'm glad you do. But next to Kathy is Dorothy Bridges, who was also on the Minneapolis Fed board, was also a senior staff at the Minneapolis Fed. And her connection to NDSU is her grandson's on the football team here. So she's always cheering for NDSU and keeping us apprised of how they're doing. So congratulations on all of your success, and thanks for being here, Dorothy. So I'd like to just spend a couple minutes and talk about why I'm here. So the president said there are 12 Federal Reserve banks across the country, and that is something that is unique about our country, is that when Congress created our nation's central bank, they said we don't want it all housed in Washington, D.C. We want it distributed around the country so that different parts of the country were directly represented in the policy-making process. So a big part of my job and my colleagues' jobs are to travel around our region, which includes Minnesota, the Dakotas, Montana, part of Michigan, and part of Wisconsin, and hear directly from you. What's happening in the local economy here? How are businesses doing? Are workers able to find jobs? What's happening to wages? And then bring this information back to Washington, D.C. I go to Washington, D.C. every 6 weeks for what you might read about in the paper. It's called Federal Open Market Committee, FOMC meetings, where we set monetary policy for the nation. In every one of those meetings, part of what I'm doing is speaking about what is happening in our regional economy. And then I'm making a recommendation on monetary policy for the whole country. So we don't get to set monetary policy state by state, right? It's one, we all share the dollar. We all use the US dollar. It's one currency for the whole country. So we have to try to make the right judgment for the whole country, but we want to know what's happening in the local economy when we make that decision. So that's why it's so important that I'm here to hear directly from you. So when we turn it over to you, I would like to hear from you what's happening on the ground here in Fargo. Are businesses doing well? I bet I'm going to hear a lot of businesses who say we can't find workers. And let me just warn you, I'm going to push back on you because I've been hearing that for years. Everybody says we're out of workers. And then miraculously, month after month after month, the U.S. economy has been creating 200,000 jobs a month when we're allegedly already at full employment. Where are these people coming from? So we can talk about that. What's happening, the wage growth. There's a lot that I think we can get into that I'm looking forward to, but I really want to hear from you. And the more candid you are with me, the more I'm going to learn. So don't pull your punches. I want to hear what you have to say. Even if you disagree with me, so much the better. So thank you for that.
That's great. And screens are closing behind
Okay.
us. So let's pick up on this workforce point first, because you've spent the day here. It's the issue in our state, and I know you hear about it in Minnesota a lot too. And you have this new institute you've launched at the Federal Reserve, the Institute for Opportunity and Inclusive Growth. Really neat stuff happening. We simultaneously here, we're working on something that we just made history last month and announced, the Challey Institute, and we're working together with your team there, so thank you for what you're doing. But that institute and your core researchers and yourself at the Minneapolis Fed have been really hammering on this point that we have slack in the economy still. There's opportunities for people who want to work, and we also can create new opportunities through immigration. So I want to dig in a little bit on immigration first. And you say that it's practically a free lunch in January 28th. And your quote here is, "This is just math. We can have slow growth, spend a lot of money to subsidize fertility, or embrace immigration. If we want a high growth U.S. economy, and I do, immigration is going to have to be an important part of that." Can you elaborate a little bit on your views there? And
Sure.
How is this Federal Reserve, kind of the prevailing sentiment, or are you a bit of a maverick on this particular point?
Well, so there's a lot in your question. So let me try to take that one at a time. First of all, where does economic growth come from? One of the sources of economic growth is simply population growth. You have more people, more consumers to buy things, more workers to produce things. And as our population growth is slowing, you would expect we're going to have slower economic growth, simply because we're having fewer kids than prior generations had. So that's the math. And that's where I say, I, for one, am in favor of economic growth. And if you're going to have fewer babies, then you need to turn to immigration to make up the pipeline, to make up the difference. And we've done that historically very successfully as a country. Now, in contrast, if you look at Japan, Japan also has very low fertility rates, lower than we have here. But culturally, they're very resistant to immigration. So Japan is literally trying to subsidize fertility, tax credits and subsidies to encourage families to have more babies. Now, let me just point out the obvious. It takes 18 years to grow a new worker, right? So it's not a fast solution, even if you can do it. And it's unclear that you can even do it. So what do? My humble opinion is we should embrace immigration, design an immigration system that meets the needs of our economy, and then that's a real source of workers, a real source of consumers to drive economic growth. So this is Neel's view. This is not within the mandate of the Federal Reserve. And one thing that maybe sets me apart that not everybody's happy about is I'm happy to share my opinion even about things that are not really in my wheelhouse. So not everybody likes that. So I think most of my colleagues at the Federal Reserve, they would all agree with the math that I just laid out. Some are going to be willing to say it. Some are maybe less comfortable getting out, outside of their comfort zone. But that's the math.
Yeah. So this math and this view is informing your stance on interest rates, though, right? I mean, you're out, I think, this week talking. The Forum might have interviewed you today, even, and you're talking about we're maybe in this just right spot now, but you last year or maybe the year before had said, I'm against the hikes 3 times. You had this op-ed at the end of the year, like this is the 3rd time I've said, nope, I'm not in agreement with this, and it's because of this issue of there's plenty of employment growth, there's plenty of people that we could still add, right? And that's kind of fueling the dovish Neel Kashkari.
That's right. So the immigration issue, and that's a long-term growth question. What happens to our economy over the next 20 or 30 years? Shorter term, we're trying to assess, are we really at full employment? So Congress has given the Federal Reserve what we call a dual mandate. One mandate is stable prices. Think about an economy that's not overheating, but also not limping along. Then the second mandate is as many Americans who want to work are able to find jobs. Now, we have mistakenly thought we were at full employment or maximum employment for the last several years. We've thought we're there. Everybody who wants to find a job has a job. And yet, month after month, people are coming off the sidelines taking jobs. Now, the thing is, this is a technical point. That unemployment rate that you read about in the paper, it's 2.5% or so for North Dakota, 3.8% for the country. That only counts workers who are actively looking for work. If you gave up looking because you got laid off and you looked for years and you couldn't find a job and you just gave up, you're not counted in that number. And so what's surprised us to the positive for the past few years is a lot of people who were not counted, who said, I'm not looking for a job, took jobs. That's wonderful. It's amazing and it's wonderful. How many more are out there? So the reason I've been objecting to our interest rate increases is I don't believe that the U.S. economy is overheating. I don't believe that we need to tap the brakes because we keep seeing all these additional workers come off the sidelines. So I'm simply saying, I've been saying, let's wait until we actually see the economy reach full potential, and then we can tap the brakes and raise rates then. Let's not tap the brakes prematurely. Now, we're in a little bit different stance where the rest of my colleagues have said, let's pause interest rate hikes because the economy is showing some signs of weakness. We're not sure yet if that's a real economic downturn or if it's just noisy data. Sometimes this data bounces around month to month. So that's really, I think, what's motivated us pausing interest rates. But I stand by my view of the past few years. We've totally misread where maximum employment is. And let's wait and see how many more people are out there. So tomorrow, there's going to be another job report that gets published. That's going to be an important one to look at. What's happening? Is the U.S. economy still creating a lot of jobs?
So your view right now is hang tight for a couple of months, get a little more data, and we're somewhere near the neutral rate or some kind of natural rate. There's a lot of concern, and we gathered some questions from Rotarians actually about the inverted yield curve. And there's a minority view that we ought to be cutting like now. We're actually behind the curve. The Federal Reserve is behind the curve and ought to cut. I have a guest coming tomorrow. We're doing another financial markets day tomorrow. Please come. We need you at that one too. This is like my 1 week per year where I get to actually think about economics and finance instead of managing the college. It's wonderful. So please come to that. One of the people there's actually going to say it should be like a 50% hike, a 50 basis point cut like ASAP. And you're more in the let's just hang tight and get a little more data camp. Okay.
So what Scott was talking about is this thing called the yield curve, which is the rate that the U.S. government borrows from all of us. So if you loan money to anybody, to your son or daughter or your neighbor, or to the U.S. government, generally speaking, you want a higher interest rate if it's a longer term loan. So you could buy a 1 month T-bill from the U.S. government. You're giving a loan to the U.S. government for a month. Or you could buy a 30-year bond from the U.S. government where you're going to give the U.S. government a loan for 30 years. Generally speaking, if you're going to lend your money to somebody for longer, you want a higher interest rate to compensate you for tying up that money. So this is the curve. If you plot all those interest rates out, it forms a curve, and that's called the yield curve. And typically that curve goes up. Well, once in a while, the curve does something funky, and it inverts, where interest rates shorter maturity are higher than longer maturity. And this has actually historically been the single best predictor we have of all the economic data we look at. This is the single best predictor when the yield curve inverts of a recession to come in a year or two. And the yield curve recently inverted. So people are nervous about that. So my reaction, the reason why I'm not clamoring for an immediate rate cut is because sometimes this data is noisy and it moves around and it bounces around month to month. And I think it would be a mistake for the Federal Reserve to be moving monetary policy, chasing around some of this noisy data. We will add our own volatility to the U.S. economy and to markets. That's why I'm saying, hey, let's just be patient. Let's watch this very carefully. Let's get some more data. Let's figure out if this is just noise or if this is a real economic signal.
Mm-hmm. One last question from me, and then hopefully there's a lot of questions from you all. And this is another one coming from a Rotarian who must be an economic historian because they're able to go way back. And there's been a long history of the Fed and its role as an independent entity of the government, kind of being something that gets a little fuzzy and gray, where there's work between Treasury and the Fed that they come into contact with each other somewhat closely. George H.W. Bush blamed Greenspan for losing the election. Richard Nixon wanted more stimulus from the Fed when he was in office. There's some accounts that Robert Rubin and Bill Clinton worked with Greenspan. If they lowered their deficit, he would cut interest rates. So there was working together. And now we are in an environment where we have a president explicitly commenting on Fed actions on Twitter, every day. And is this just, kind of more of the same, just amplified by social media, where there's always been this tension between independence and you guys got to help me here? Or is it actually a new day in terms of it's just a little more rancorous and heated?
Right. Well, so this is, let me take a step back. The idea of having an independent central bank, basically over the last 30 or 40 years, economies around the world figured out that if you keep monetary policy independent of politics, you make better decisions. Because most politicians of either party, if election time is coming, they're going to say, hey, cut rates. We want to boost the economy when it's time for me to get reelected. But that may not be the right thing for the economy. So Republicans and Democrats have basically said, you know what, let's keep monetary policy independent, leave you all to make better decisions. And by the way, that's why we are structured the way we are. So the President of the United States gets to appoint the governors in Washington, D.C. There's 7 of them. The chairman of the Federal Reserve is Jerome Powell. appointed by President Trump. Before Jay Powell, we call him Jay, was Janet Yellen, appointed by President Obama. Before Janet was Ben Bernanke. Before Ben Bernanke was Alan Greenspan. You may have heard of these names. Then we have 12 regional Reserve Bank presidents, including me. I was appointed by Kathy Nezitt. I wasn't appointed by the President of the United States. Kathy Nezitt can fire me. The President of the United States cannot fire me. And that is designed to keep the Federal Reserve independent of the day-to-day throes of politics in Washington, D.C. So I think most people agree keep the Federal Reserve independent is right for the country. Now, in terms of the current environment, presidents are free to say whatever they want. And I can tell you with great confidence that my colleagues and I don't pay any attention. We focus on the data. We try to make the decisions as best we can based on the data we have available to us and based on the goals that Congress has assigned to us. So that's why I've got a great degree of confidence in the Federal Reserve as an institution, because we are all totally committed to our independence.
That's great. Questions from the audience?
Microphone's coming to
and
you.
please wait for a mic. If you all could introduce yourselves too, I think that would be great for Neel and for we're live streaming too, so my mom is watching. Please let's say hi to my mom.
Can you put it closer to your? Can you switch it on?
So, just a quick follow-up on what you just said. But you do have to pay attention to the fiscal deficit and to trade policy, correct? And so, can you comment a little bit about the intersection that happens because federal fiscal policies and policy toward trade certainly has an impact on what you can do in the Federal Reserve System as well?
That's correct. So we have teams of economists around the Federal Reserve, around the country, who are always analyzing the U.S. economy. And it's not the U.S. economy in isolation. It's looking at the U.S. economy in the context of the global economy. So you're right, fiscal policy affects the U.S. economy. So Congress passed a big tax cut. Our economists had to model, what do we think the tax cut is going to mean for short-term economic growth? What do we think it's going to mean for long-term economic growth? Same thing with the tariffs. There's a trade battle going on now between the U.S. and China. Our economists try to model, what do we think these tariffs are going to mean for the U.S. economy in aggregate? And that could have an effect on inflation. That could have an effect on U.S. economic growth. So fiscal policy is absolutely an input into our analysis of the trajectory of the U.S. economy, and that can affect monetary policy. So we do pay a lot of attention to that and try to understand it, but that is a little bit different. Those are decisions by Congress or by the White House. We want to analyze what they're doing. That's different than us changing our decisions based on what their political preferences may be.
Thank you for coming to Fargo.
Thank you.
I've been a financial advisor for nearly 40 years and spent an awful lot of time. It's a humbling job trying to predict interest rates. And I have found something that might just be the best way of doing that. And it's the body height of the chairman of the Federal Reserve. Going from Volcker to Greenspan to Bernanke to Yellen, the correlation is pretty clear. Now we have Powell, and all of a sudden rates have gone up. So I think there's reason to the madness. In all seriousness, I'm kidding, but in any event, I have a chart of that, pictures of these people, and with the correlation of interest rates.
And by the way, so Janet Yellen may be short in physical height. She's an economic giant, and she also started the rate hikes. So she didn't keep rates low. She's the one who started us raising rates.
It's never too late to grow. In any event, in predicting interest rates, which is humbling, I have for years had clients tell me that interest rates can only go so low, and the benchmark is always in the back mirror as 1980, 81, 82, which was an aberration of extraordinarily high rates. And so we got interest rates declining precipitously for nearly 30 years. Never thought I'd see the day where interest rates went to not only zero, but negative. help me understand. There's $10 trillion globally of negative interest rates throughout the world. The United States interest rates are higher virtually than any industrialized nation. How does that work?
Sure. Well, we think it works. So what is the Federal Reserve doing? We are moving interest rates up and down around this long-term trend of where neutral is. What interest rate represents neutral, that neither stimulates nor restrains the economy? If you look over the last 30 or 40 years, as the gentleman was just saying, they've gradually been declining all around the world in advanced economies, from very high rates in 1980 to almost zero, call it close to zero today if you look around the advanced economies. That's not because of us. That's because of broader macroeconomic factors such as demographics. We know that advanced economies, we talked about this earlier, they're all aging. And the savings and investment dynamic, how much you want to consume versus how much you save, it changes as societies age. That's one factor. Another factor is technology development and productivity growth. There are a bunch of macroeconomic forces that I'll be honest with you, we don't fully understand. We haven't fully been able to disaggregate this, that are driving these long-term low neutral interest rates. And what is the Federal Reserve doing? We're managing rates around this long-term trend to try to boost the economy or slow it down, but we're not setting the trend. The trend is set by these broader macroeconomic forces that are fiscal policy, as the professor behind you talked about, technology development, demographics, productivity. These are the things that we think are setting this long-term trend down. It's not a fully satisfactory answer. I can judge by the expression on your face. And that's okay. That's the best I can do, though. I'm being honest with what we know and what we don't know.
Why would you pay somebody to keep
Well, why would anybody have negative interest rates? Why would you ever say, in some countries, you can loan money to the government and you're going to get less back? People are willing to do it because they feel safety in holding that security. That, you know what, and I'm not in favor of this, but I'd rather know for sure I'm going to get 99 cents back from the government than invest over here where maybe I end up getting 75 cents back. So there's a safety value. Whenever there's a shock in the global economy in the last decade, for example, everybody runs to US Treasury bonds because people think that they're safe. And so even if the return is very low relative to what you expected in 1980, you know what, hey, I'd rather get, there's an expression that I'm forgetting right now, return of your money is better than return on your money in some cases.
Hi, my name is Abby Gold. I'm the acting chair for the Department of Public Health. And I just want to switch gears a little bit and ask you about some of the research that you do with the Federal Reserve. I know that the Minneapolis Fed has been really active, for example, in looking at home visiting and the return on investment of home visiting programs, or of early childhood education, or now I know they have some tribal initiatives. So could you talk a little bit about that?
Sure, thanks for the question. So we have a team of researchers at the Minneapolis Fed, each of the Federal Reserve banks do, and their day job is supporting me in assessing the state of the economy and making monetary policy recommendations. But these are brilliant PhD economists who have wide research interests, and they take those interests into a lot of different areas. So the Minneapolis Fed has done a lot of work on early childhood development, arguing, the math is pretty compelling, that $1 invested in getting kids education very early in their life pays off for taxpayers long term through much better health outcomes, labor market outcomes, et cetera. So that's some economic analysis. And while we don't control education policy in the Federal Reserve, my view is if we can do the analysis and then give that analysis to legislators, they can then carry that forward if they find that compelling. So education is an area that we care a lot about. We also have a center on Indian country development, looking at everything from housing to education to different economic challenges on reservations around our region and around the country. We have researchers who are dedicated to doing research on that as well. So there are a lot of different issues. And then Scott mentioned this new institute that we've launched, which is looking at economic disparities, regional disparities, racial disparities across the country. Why are they so persistent? Why have they been with us for so long? What are the drivers of that, and what can we do? That's another key area of research interest that we have. Thanks.
Hi there, my name is Rachel Sweeney. I'm working on an undergrad in accounting here at NDSU. Could you share with us what your forecast models are predicting the effect of the Tax Cuts and Jobs Act will be on the economy?
I'd say it's still unclear. We know that when the tax cut that was passed was a deficit finance tax cut. So you didn't cut any spending, you just cut taxes. So now, in a sense, you put more money in the economy, more dollars, because the government's taking less out. You know at a minimum that's going to provide a short-term stimulative effect, because you're just putting cash into the economy, in a sense. That's easy to model out. So we saw strongest growth in 2018. We expected to see the slower growth in 2019, though still a boost because of the tax cut, and then slower growth yet in 2020, but still some boost from the tax cut. That's easy to model out, and that's happening. Now the question is that tax cut going to lead to more investment, and is that going to lead to higher long-term growth? That is as yet unclear from my perspective. We have seen some uptick in investment, but I don't think we've yet seen a huge boost in investment and a huge boost in long-term supply or long-term productivity. Those are harder to spot, and I think it's still too soon. So I think it's a little early yet.
My name is Alan Sarek. I'm a sophomore here at NDSU, majoring in finance and economics. I have a question about the future of Federal Reserve monetary policy with regard to their rates and the balance sheet. Given the high degree of stimulation the economy is under right now and the slowing growth we're seeing around the world, we see ECB, European Central Bank, and the Bank in Japan having trouble to stimulate their economy because they're already so stimulated. Do you see us getting in this situation sometime in the future where we're not able to stimulate the economy with lowering interest rates? And do you think the Fed has another tool that would be able to stimulate the economy?
So I would say I'm going to give you a two-part answer to that question. And one part is, if we have a recession, what will the Federal Reserve do in response? So the first thing we would likely do is cut the interest rates. They're just under 2.5% today. We could cut them back down to effectively zero. Now that's a smaller cut than we would have made historically. Historically, you would have guessed interest rates were at 5%, then you've got 5% to cut. Here they're only around 2.5%, so you only have about 2.5% to cut. But we have other ways of stimulating the economy. So one is quantitative easing, which you mentioned, which is we buy up long-term treasury bonds to try to drive down long-term treasury rates directly. That, I think, provided some stimulus in the last recession. It was an unproven tool before. I think we've got more experience using it. That is available to us if we had to do that again. And we have something that we call forward guidance, which is signaling to the market what's likely to happen to interest rates in the future. And let me give you, this is technical, but bear with me for a minute. The interest rate that we move up and down that I said is just below 2.5%, that's an overnight interest rate to banks. Now, if you borrow money to buy a house or to buy a car, you don't care about overnight interest rates. You care about interest rates for the next 10 years, the length of your loan. So what are we doing? When we lower short-term interest rates, we are sending a signal about the future path of interest rates over, let's say, the next 10 years. So it has some effect on long-term interest rates. Well, if we tell you, hey, we're going to hold interest rates at zero, and I'm going to make it up a scenario. Let's say we announced we're going to hold interest rates at zero for the next 5 years. That would have a very powerful effect on long-term interest rates. And that's an example of forward guidance. So one action we could take is lower interest rates to zero. A more powerful action is lower interest rates to zero and then tell you we're going to hold them there for the next 5 years. That's another way of boosting the economy by driving down long-term interest rates through what we call expectations of the path of interest rates. So it's technical, so we do feel like we have other tools at our disposal. Now, second part of the answer, in a normal environment, what I think you're seeing with Japan, they're not trying to respond to a recession. They're struggling to get their economy to grow, period. And that is about, in my opinion, demographics. So Japan's population is hardly growing. Their demographics are far worse than us. They do not have the safety valve of immigration that we have. And so to me, I don't think we're going to go down the path of Japan because our demographics are better. And while we're not perfect at immigration, we're better than anybody else. And I'm speaking from experience. My parents came here from India. I'm married to an immigrant. We're not perfect, but we are pretty darn good at figuring out how to welcome people into our country and make them productive. And that's a huge competitive edge that we have over virtually every other country. On this side.
Tom Campbell, a businessman. Question on this, our federal debt, which seems political suicide for anybody to lower it, raise, it's about $1 trillion a year. It's at 22 trillion, and there's a lot of people very concerned about it. Is that an influence into you of not raising interest rates because of the increased cost, of course? And what's your opinion of that? Or what's going to happen if another 10 years, that's another $10 trillion. What's your opinion of that? Even like Paul Ryan, a lot of these conservative Republicans gave up on it, and that was what they won in elections. So it concerns me. What's your opinion?
And then they passed a big tax cut. My opinion is, well, first of all, it's not a factor in our deliberations. That's not our, I'm going to be blunt, not our problem. That's between the Treasury. This is the difference between fiscal policy and monetary policy. That's up to the Treasury and the Congress to decide how much they want to spend, where they get the revenue, and how they finance the deficits. That's not our job at the Federal Reserve and does not factor into our deliberations on what the consequence is going to be for Treasury's budget if we were to raise interest rates. Our job is monetary policy, looking at maximum employment and stable prices and making the right decision based on those goals. Now, long term, we clearly have a fiscal issue because no country can afford to just keep increasing their deficit forever and ever and ever. Having said that, right now, investors around the world are saying that they have a lot of confidence in the US economy. Because right now, with all the debt that you just talked about, Treasury is funding itself at around 2.5% for 10 years. Treasury yields are still very low. So we know long-term this can't go on forever, but at this moment in time, investors around the world are saying we have more confidence in America than we have just about in any other country, even despite all of our problems and quirks that we have. So when is that confidence going to run out? That's what we don't know. And it's not simply up to us, because investors have a decision to make. It's like, who's the strongest weakling? If Europe gets its house in order, imagine that. That's a big economy, and all of a sudden, imagine 5 or 10 years from now, Europe's fiscal situation is really good, and their economy is growing. Investors around the world might say, you know what, Europe looks like a better place to invest than America. Then all of a sudden, our runway will shorten on how much time we have to deal with this. So right now, we don't have a problem. We know it can't go on forever, but what is that inflection point? We don't know, and it's not only up to us. It's our relative position relative to the other major economies of the world. And right now, we are a much stronger economy, and people have a lot more confidence in our economy than they do in Europe and they do in China. And that's partly why the US government's able to fund itself so cheaply, despite the fact that we have all this debt.
I think there was another question up here, maybe, Tom? Right up
over here.
Oh.
Thank you. Becky Wallen with Bell Bank. Thank you for joining us here today. With your level of engagement during the financial crisis, I'm curious to hear your thoughts on what some are calling the crisis in student loan debt at about $1.5 trillion in our country, and then also any concerns or research that the Fed might be doing on consumer debt as well.
So, and what was your name again? Becky. So she asked about, during the financial crisis, I was at the US Treasury Department, and from 2006 to 2009, under both Presidents Bush and President Obama briefly, and I ran the TARP program. So there was the $700 billion bailout of the banking system that I ran. Now, number one, we never want to do that again. All right, it was the right thing to do, but we never want to do that again. In terms of student debt, it is something that people at the Federal Reserve are paying a lot of attention to. We don't see it as a ticking time bomb the way the housing bust was, but we do know it's a huge economic issue because it is, number one, education is only going to be more important in the future than it is today. And we have to find ways of educating more and more of our young people. Doesn't mean every kid needs to go to four-year college, but almost every kid's going to need at least a high school degree, graduation, or something beyond it. So we need to find a way of educating more and more young people with a good education without saddling them all with more and more and more debt. So we have to somehow challenge our universities to increase their scale without just driving up costs at the same time. And more student debt is clearly not the answer. So that's a big macroeconomic issue. That's a big economic competitiveness issue when we think about our position relative to China, relative to Europe. I talked about immigration as a competitive edge for America. Our higher education institutions are also a profound competitive edge for America. We're able to attract brilliant people from around the world who want to get educated here. If we lose that lead, then we're not going to be the magnet that we have been for talent from around the world. So we have to find new models of educating more people, and it cannot just be more and more debt. And then there's also a short-term economic issue, which is, and there are a lot of articles written about this, if young people have a lot of debt, then they can't buy a house. They can't buy a car. It's delaying starting a family. So there are knock-on effects of just saddling kids with more and more debt. It's not a long-term sustainable model. But I'll be candid with you, I don't have the answer either. And then we are paying a lot of attention to overall consumer debt. Consumers are saving a lot more than they were before the financial crisis. So the distribution of debt is uneven. Some families are very indebted, other families are not. On average, American consumers are doing much better than they were before, but there's a lot of heterogeneity within those averages.
So we have a lot of students in the room. You all should watch Too Big to Fail. Neil's character makes an appearance in there. And he's like even younger than he is now, which is kind of crazy for you to have been juggling that. I wonder if we can just
My dog makes an appearance.
Yeah.
So they actually had a casting call looking for a brown Newfoundland to star in the movie. So
and it's actually your dog.
It's not actually my dog.
Okay, got it.
But there was a dog playing my dog in the movie.
Got it. So I wonder if you can talk to students about your own journey a little bit in terms of, from what I understand about your bio, some of it was just grit, being in the right place, asking, like Frank, just point blank telling people who seem way too big to ever approach, like, I want to work for you. And it didn't work out at the time, but then it actually came around to like you working for like really influential people in finance and your journey through finance, PIMCO, and then running for governor, which seems totally nuts too. I wonder if you can just talk a little bit about, what you've learned, and what is exportable to them, through your own journey.
I'd say I've done a lot of different things. So I started out as an engineer working in aerospace, developing technology for NASA missions before I went to go to business school. And why did I go to business school? My managers at the aerospace company I worked for were encouraging me to go get my PhD. And I knew I loved engineering, absolutely loved R&D. But I knew if I went and got my PhD, I'd really be committing, the next 20 years, this is what I'm going to do. And I was not ready to make that commitment. So I said, I want to go learn something new. Let me go get my business degree and just learn, see what doors open, see what I'm exposed to. I think that's been kind of the signature of the various twists and turns that have gone on in my career, is I want to pursue things that I find interesting, where I'm going to learn a lot and challenging. So when I graduated as an engineer, I visited a tractor factory here earlier today. That's why I'm wearing jeans. Apologies. Most of my colleagues at the University of Illinois were going to Caterpillar or John Deere or Ford or General Motors. Great companies. I said, I want to go, what do I think is the biggest engineering challenge? Designing satellites for NASA. So let me go try to find a job designing satellites for NASA. That's kind of been my signature, which is I want to go after the biggest challenge I can find, doing something that I think is important. So when I had a chance, I called up Hank Paulson, who was the CEO of Goldman Sachs. I was a junior banker at Goldman when he got picked to be Treasury Secretary. I didn't know him. And I cold called him and I said, I want to come work for you. I don't care if I'm going to lick envelopes. I just want to serve. And long story short, he checked me out, vetted me, and said yes, and I joined. And people at Goldman, my managers, said, you're crazy. You're going to give up your great career at Goldman, you're early on, to go take this staff job at Treasury? What's the matter with you? And I said, what's the matter with you? This is a once-in-a-lifetime chance to get to serve and to learn something. And what if I don't like it? I go back to the private sector. That's fine. So I guess the only thing I could share with you is there's been no plan. There's been no journey mapped out on a piece of paper. It's been do something that I find genuinely important and challenging. And I found if you do something you care about, you're probably going to give it your all. And to give it your all, you're probably going to do a good job. And if you do a good job, it'll probably lead to new things. And that's kind of worked out. When I ran for governor of California, I learned the hard way that there's no prize for coming in second. Okay? I came in second, which is pretty good, except there's no prize for coming in second. And I never thought about joining the Fed. And then the Minneapolis Fed, the search committee that Kathy served on, was doing a search for a new president. And they had a nationwide search firm that contacted me, said, would you be interested in applying? And I said, gee, I hadn't thought about this. Let me think about it. And then I met the search committee, and I've been there 3 years, and it's been wonderful. So I guess my bottom line is, don't try too hard to map out your career. Do something you're genuinely passionate about. Give it your all. Be willing to take risks, and good things will happen.
That's great. Shifting back to North Dakota just for a minute here. So I've been here 3 years too, and I feel like we will have made it as a state when I stop looking at gas station prices. You know, so I can't believe how often I'm like looking each day going, oh, it's in the 240s. The state budget isn't going to be cut. You know, like I can't believe that I watch like Casey's General gas prices like as often as I do. And I wonder if you can comment on this, because it's probably the other thing you get if you spend time in our state is we've got the workforce issue and the shortage of workers. Governor Burgum was here a few weeks ago, said 30,000 statewide. We have a commodity-driven economy that's ag, oil, and we yo-yo around based on our fortunes in those two industries. And there's a lot that's been focused on diversifying and trying to find other outlets for workers and services in our economy, but we're nonetheless really tied to them. And I know the Fed has tackled this a little bit, and I wonder what your own thoughts are on how to stabilize things a little bit here to just be less reliant on those two core industries.
Well, let me, before I answer the second part, on the workforce shortage, I actually use North Dakota as the example of the opposite. Because all these businesses say we can't find workers, and I say, really? Are you raising wages? No. Then I say, well, you're just whining, all right? And the proof is the oil patch. When oil prices really skyrocketed and they needed workers, they drew in workers from all around the country because they paid up. And workers from all around the country came. So I always say to businesses, I will know you're serious when you raise wages. Until then, you're just talk. It's just a bunch of hot air. And North Dakota is the proof that if you raise wages, people will come. And I'm looking at Kathy because she's living in the middle of it. She lives in Minot and works up and down the Bakken region. So I don't believe in this workforce shortage. I think it's businesses being reluctant to try to raise wages. And businesses will say, we can't. We can't pass these costs on to our customers. Well, if every business says this, no business will try. And so I'll believe it when I see it. So that's the first part. Second part, it's very hard to diversify an economy. I did meet a bunch of manufacturers today. It seems like the manufacturing sector is growing. It may be a small sector, but it's a growing important part of North Dakota's economy, here in Fargo especially. I think the fact that you've got two commodities that are largely uncorrelated, you're a lot better off than if you just had one.
That's true.
Right? So you've got ag that's been suffering for a number of years. By the way, ag is suffering because producers are so productive. Every year, it's record harvest after record harvest after record harvest. So it's a curse of riches, so to speak. And then you've got the oil sector, which is at least somewhat of an offset to that. So I think in some sense it's a high-class problem that you've got these two very productive sectors in your economy. And then you have these centers like Fargo, excellent universities, a small but growing tech sector. You've got manufacturing. I mean, I think, there's a glass half full story here that I think I see more than a glass half empty.
We've got about 10 minutes. I have a career idea for Neel that I want to talk to him about right at the end. But if you guys, like 8 or 9 minutes here, help me with some more questions.
My name is William Ganje. I'm an economist here at NDSU. So I wanted to ask a question, but first, why would Illinois not play Bison football? But
I don't know.
my main question, I'm from Illinois also.
Oh, you are? Okay.
My main question is, you talked about the tax, that it will never happen again.
The what?
The tax, the bailout.
Yeah. I hope it doesn't happen again. I don't want it to happen again.
Okay, so if we have hostile takeover and another recession, so what are the controls? What are the checks? What are the safety nets to really make sure that it doesn't happen again?
So we at the Minneapolis Fed have done a lot of work on the issue of big banks and too big to fail, bringing down the U.S. economy. And we are a lonely voice, not a sole voice, but a lonely voice in arguing that the biggest banks in America are still too big to fail and that they need a lot more of their own skin in the game, a lot more capital to protect all of us in case they make mistakes. So if you go get, I know we have a lot of bankers here, if you go get a home loan from one of these wonderful bankers, they are probably going to make you put 20% down on your house. When my wife and I bought a house in Minnesota, we had to put 20% down. Why did we have to put 20% down? That 20% is there to protect the bank in case we run into trouble. And if I put 30% down, the bank has even more protection. So the more of your own money you put down, the safer everybody else. Well, the big banks only have about 10% down on their investments. In fact, small banks in America have a lot more money down, a lot higher capital than big banks. It's the opposite of the way it should be today. So our analysis says that we need to basically double the amount of equity capital in the biggest banks in America. And if we did that, we could largely protect the taxpayers from these banks making mistakes. Doesn't mean they're not going to make mistakes. Everybody makes mistakes. But it means that they would have enough of their own skin in the game to absorb the losses when they made mistakes so the taxpayers didn't have to ride to the rescue again. Now, today in Washington, the winds are blowing in a deregulatory direction. So this is an uphill fight. But we're going to keep trying to get the message out so that the American people know what's at risk. And again, what's motivating this is we don't want to have to bail them out again.
My name is John Andreasen. I had the privilege of working in Norway as a student and translated the first 150 years of Norwegian economic history. In the last 50 years, oil has moved into Norway and has really dominated the culture and the economic system in Norway. But they're facing ethical questions now about global warming and their investments. In your research work, would you comment on global warming and how the Federal Reserve Bank might be addressing issues related to global warming?
So, I consider myself to be a person of science. I'm 2 engineering degrees. My father was a professor of engineering. My mother was a doctor. I believe in science. So if the best scientists in the world are telling me something, I take it very seriously. Now, I will say that the Federal Reserve's mandate is a much shorter term mandate of the ups and downs of the economic cycle. So I'll be candid with you. Global warming does not enter into my deliberations about my recommendations for monetary policy. But we are aware that it's a long-term issue that must be addressed. I think now, getting way outside of my mandate, I think the science around global warming is pretty clear. I think the solutions that have been proposed thus far are wanting, shall we say. I mean, the most economically sensible solution that's been proposed is some form of carbon tax, where you're not interfering in individual markets. You just tax carbon, which is the bad issue, and then let the market adjust to that. And then you could make that revenue neutral, and you could make it, if you just do a gas tax as an example, a gas tax is very regressive. It disproportionately hurts low-income families. So if you did some kind of a carbon tax and took the revenue and made it revenue neutral, and you could offset some of the distributional implications, that would be an economically efficient way of attempting to address this. But I think we need to do a lot more work on the recommended solutions that have been proposed so far. So far, some of these climate agreements, the countries that have signed up to them aren't achieving very much. A lot of it so far is just political theater and empty promises. If we're really going to be serious about this, then we need to really look at serious solutions, and I haven't seen those yet. That's one person's opinion.
Is that a student down here?
Hi, my name is Lee. I was curious in your opinion regarding long-term inflation. So I guess when you take away like vehicle purchases, college tuition, and probably real estate, like the rest of the things that we buy are largely immersed in e-commerce. So with the dynamics that e-commerce has brought in the last couple of years or a decade, do you think that you guys need to think inflation in different terms of how you have in the past, or kind of your interpretation on that?
So we look at that. It's a funny thing. So on one hand, let's say e-commerce is keeping prices low because it's reducing the power of retailers to pass costs on to you and me. I mean, from an aggregate economy perspective, that's great. As a consumption perspective, that's great for us as consumers. And that means we've got more room to run before the economy overheats. Now, what gets complicated about this is when we also look at productivity growth has also been low for the past decade or so, past 20 years, lower than it was 30 or 40 years ago. If e-commerce and artificial intelligence and some of these new technologies were as transformative as the hype makes it sound, you would expect productivity growth to be really high. Productivity growth is actually really low right now. And so it's a little bit of a puzzle on what's going on. Is this stuff really transforming the economy? I mean, some of the technology development over the past decade is not productivity enhancing. I mean, I would argue Facebook is not productivity enhancing. I don't think Twitter is productivity enhancing. Instagram is not productivity enhancing, in my humble opinion. So these are like leisure devices, in a sense. So if the innovation that's taking place in the economy is making us get more leisure for our dollar, is that really boosting the economy? So this is, I mean, you're asking a good question, but it's a very complicated question, and I don't have a simple answer. Looking at e-commerce and the effect on inflation is part of it. Looking on the effect on productivity is also part of it, and trying to reconcile these various signals that we're getting makes this very complicated. Now, a lot of these things, last thing I'll say, then I'm going to shut up. A lot of these things are global phenomenon. So e-commerce is happening all around the world. Technology, if you invent some new technology here in North Dakota, you can pretty quickly export that around the world. So a lot of these trends tend to be global in nature. We're seeing low productivity growth all around the world. And that's why we don't think it's just a measurement error in America. We think there's something fundamental going on. I've said that the most impressive technology development in the last decade is not in Silicon Valley, it's in the Bakken. It's had a bigger effect on the global economy than anything out of Silicon Valley in the last decade by effectively putting a cap on energy prices. I mean, that's profoundly important to the global economy. And that's not where it's getting all the attention. It's Facebook and Twitter and Instagram and things like that.
Got time for maybe one more question, if anyone has one. John?
John Glover with the NDSU Foundation. So you're covering a lot of ground on a lot of different topics, which is fantastic. So kind of two questions, maybe to cap before Scott asks his final question. What concerns you most about America's future, but also what gives you hope for America's future?
The concerns I have for America's future are really short-term concerns, which is I'm concerned about the things we can control. We can't control the European situation with Brexit. We can't control China. The thing that I'm most focused on is I don't want the Federal Reserve to screw something up by raising rates too much and ending the expansion. So that's a short-term concern. Long-term, I'm totally bullish on America. I mean, I wouldn't trade places with any other country in the world by a mile, as much as we seem like we have dysfunction. So after I served my time, sounds like I was in prison, after I served time at the US Treasury Department, I got really into American history. Because I was part of the government. Where did this government come from? I read some in high school, but I've read a lot of American history in the last decade. I really love American history. And the more American history I read, the more bullish I am about our country and the less freaked out I am about our current political climate. We've been through wild political times before. It's the period from my reading of history, the period from, call it 1976 to 2016-ish was the anomaly of very peaceful political transitions and not much upheaval and everybody kind of getting along. Most of American history is one of people bashing each other metaphorically over the head about politics. And so I'm really bullish on America. And I look at the political anxiety that we're all feeling right now, and I think our institutions are really strong. I think we've got 3 separate branches of government. They are each strong in their own way. The Federal Reserve is totally committed to our independence. So the free press, I mean, you think the free press is not strong right now? You bet they're strong. So the major institutions of our country I view as being very, very strong and great examples for the world of how strong independent institutions can act. So, we've got a great innovation culture in America. Most countries would love, I was making fun of Facebook and Twitter, most countries would love to have one Apple or one Facebook or one Microsoft. We've got almost all of them. So there's something about the American innovation culture. We've got the Bakken. We've got all this innovation taking place. We've got these great universities. We got to get some minor things right. We need to get our immigration policy right so we can make sure we're continue to attract the best and brightest. Got to make sure we're funding our universities, making sure kids get a good education. And then we got to let the country run. And I think we'll be great.
Thank you so much for being here. I want to wrap on a lighter note. Kathy got you as far as Minneapolis, and Fargo's 3.5 hours down the road. We need you in higher ed too. So you've done private sector, you've done public sector. There's one thing missing, which is maybe helping me with my MBA class. So if you ever get the itch, think about us. You're up in the cold anyway. Consider coming a little farther west and entertaining NDSU. And if we can't sell you on that, I've got a little gift for you. And my boss is here. So this is part of our enrollment strategy long term. And I'd like you to open this just real quickly and be thinking about 2037, 2038 if you can.
So that's part of it.
That's part of it.
And then, baby clothes. That's great. Thank you very much.
Thank you. So Alan Greenspan, supposedly when he sneezed, like markets went down. If we can get you to do a horns up, markets are going to take off tomorrow.
So I want to make sure I do it right.
Let's get right there. The president's watching. Yep, we got it.
Hey, thank you very much
so much for being
me.
here.
This was really fun.
So, thank you.
That was great.